Hello guys, welcome to Unisys weekly fundamental analysis. So first of all, as usual, we'll look into the dollar. Okay, the dollar index rebounded in sharp this month, mainly due to the sharp rise in the US bond yields. But Biden's 1.9 trillion stimulus policy and the Federal Reserve easing commitments limited the dollar's gains. Okay, so higher US Treasury yields have caused more funds to flow into US assets in pursuit of profits, thereby supporting the US dollar. The yield on the 10-year US Treasury bond has also risen sharply. The US 10-year Treasury bond yield has always been defined as the anchor of global risk asset pricing. Since the Spring Festival, the yield has risen by 20%, just returning to the level where the COVID-19 epidemic began to detonate the financial market at the end of February last year. So the Federal Chairman Powell promised not to easily tighten monetary policy to put pressure on the US dollar. Although the global economy is in the context of accelerating vaccination, the economic recovery is expected to continue to heat up. However, the Federal still seems to maintain a cautious view on the prospects for future recovery and promises to continue to maintain accommodative policy measures for a long time. The federal policy puts pressure on the US dollar. Powell said when attending the Senate Banking Committee hearing this month that the inflation rate and employment rate are still far below the federal's target, which means that the loose monetary policy will remain unchanged. And next, we look into the global vaccination is accelerating and the growth rate of the epidemic has slowed, which is not conducive of safe haven US dollar. Okay, the global COVID-19 epidemic is still spreading, but in the past month, the global growth rate of confirmed cases has continued to slow down. According to reports, the largest vaccination campaign in history is underway. Accelerate the global promotion of vaccination according to statistics as of February 22 of February, the total number of COVID-19 vaccine in 92 countries and regions around the world reached about 205 million doses, exceeding the total number of confirmed cases, and this number is currently increasing at an average daily rate of about 6.44 million doses. And besides, the well-known investment bank Goldman Sachs continues to bearish on the outlook of the US dollar. The Goldman Sachs believe that although global bond yields have generally risen, the US dollar is expected to generally fall against the G10 currencies and emerging market currencies. And furthermore, Goldman Sachs stated in an research report that as long as US short-term interest rates remain low and other curves are changing, the dollar may still be under pressure. The US dollar is also expected to fall against emerging market currencies as bond yields fall due to valuation constraints, and vaccination and economy reopening in the next 6 months will drive rapid global growth. Alright, so next we're looking into the euro. Slow recovery of the Eurozone economy. Okay, so the Eurozone economy shrank by 0.6% in the fourth quarter of last year, better than the market expectations. At present, the Eurozone is hoping to accelerate the distributions of vaccine to help accelerate the economic recovery, but the recovery process still faces multiple risks, and related fiscal and monetary support measures are expected to continue. The revised data released by the Eurostat on the 16th showed that the Eurozone gross domestic product (GDP) in the fourth quarter fell by 0.6% from the previous month, and the decline was smaller than the previously announced 0.7%. The Eurozone GDP fell by 5% year-on-year in the quarter, which was smaller than the 5.1% previously announced. The data also shows that in the fourth quarter of last year, the euro economy shrank by 0.4%, month on month and down 4.8% year on year. The data shows that the Eurozone economy has shown a certain degree of resilience in the continuous escalation of the blockade measures. Besides, the European Central Bank expects the Eurozone economy to recover from the middle of the year. So, the bank president Lagarde said that affected by the COVID-19 pandemic, the Eurozone economy is expected to begin recover from mid 2021, but there are still uncertainties. Before the middle of next year, it will not return to the level of economic activity before the epidemic. The European Central Bank predicts that the real GDP growth rate of the Eurozone in 2021 is about 4% or slightly lower. But this is a substantial increase compared to the 6.8% drop last year. Lagarde emphasized that everything depends on the progress of the vaccination policy and the vaccination operations, as well as the economic measures taken by the authorities in response to the development of the epidemic. And the European vaccine accelerates its promotion but lags behind the UK and the US. So at present, the Eurozone is hoping to accelerate the promotion of vaccine work to help accelerate the economic recovery. The EU Commissioner for Economic Affairs, Paul Gentiloni, said on the 15th that the success of vaccine work is crucial to economic recovery, but at the same time, the importance of decision making is self-evident. What about the 750 billion euro economy recovery plan? Reasonable use is critical. We can say that. All right. So next, we're looking to the pound. The UK is one of the fastest vaccination countries. Yes, with the removal of some restrictions, the country's GDP in the second quarter is expected to grow by 4.7%. The third and fourth quarters are expected to grow 2.7% and 1.5% respectively. With the survey also shows that the British economy is expected to grow by 4.7% in 2021. The previous forecast was for a growth of 4.9%. The median estimate for 2022 increased from 5.3% to 5.5%. In addition, money markets no longer bet that the Bank of England will cut interest rates in 2021. Traders now believe that the Bank of England's policy rate will not change this year. This marked a significant reversal of the situation that occurred in September last year. At the time, traders believed that the Bank of England would lower the benchmark interest rate to negative 0.1% this year because the Bank of England said it was studying the feasibility of lowering interest rates. The views that triggered this shift was the Bank of England meeting this month, at which policymakers emphasized that although banks are encouraged to prepare for negative interest rates will not appear so soon. So due to the UK's vaccination campaign, the Bank of England's optimism about a strong economic rebound has further weakened expectation for easing policy. So last of all, it will be the forex calendar for next week. So as usual, for traders who would like to trade, so please set your stop loss. So that's all for today, and thanks for watching.